very pleased to chair this panel of policy makers. Always, there's nothing like people who are actually pulling the tiller and making the decisions. So it's really a privilege to me. We have Amir Yaron, the governor of the Bank of Israel. So thank you very much for being here. Austan Goolsbee, president of the Federal Reserve Bank of Chicago, and John Williams, president of the Federal Reserve Bank of New York. So we got the United States covered, especially include you. Anyway, the title is Policy Panel, which means you're all over the place. You can talk whatever you want about. And I know that Amir is going to talk a little bit about Israel. Maybe, we don't know, we'll have to see. But you have slides and they're ready to go, so please proceed. Thank you.
Okay, first of all, I want to thank John, and Michael. I want to say a few things sort of on the perspective of policy and thinking of policy from what do you do when it's a really hot situation, and then you really think you have to think of markets malfunction, you have to make sure they're functioning, and versus sort of more normal sort of monetary policy. And so what I'll do is I'll start with a little bit of what's been going on in Israel and what we've done as things just happened around October 7th. And then I'll move on to talk about how I think a lot of small open economies are thinking about monetary policy. In particular, showed that the Fed's movement have sort of a headwind advantage, but nonetheless, a lot of central banks don't use that and sort of go through what might be the arguments that you won't use the Fed's headwind in your policy. So let's get going. Before the war, Israel was on a really soft landish approach. You could see we grew immensely after COVID, 9.3 and 6.5. We're on a path to 3.5% in 23. Debt to GDP rose to 72 in COVID after it was 60. And then because of this growth rate in fiscal, it went back down to 60. Tight labor market on the right-hand side at the top, and on the bottom left, you could see inflation was going to go into our target, which is between 1% and 3%, somewhere around Q1 24. So that was and we have about over $200 billion of reserves. That's about 40% of GDP, large net asset position of the country. So in that sense, there are a lot of buffers. Israel has sort of pretty strong history of recovering. The economy tends to be very resilient. The reds are different war events, but in gray it's COVID, you could see. And then this event over here, the current war, what it had done to Q4 23, this is minus 21% on an annualized basis. You could see it's sort of an order of magnitude different event than before. But nonetheless, as I said, Israel knows how to recover, and so far it looks like that's what's going on. So what you're seeing here, 2023, instead of that 3.5, we ended up with 2%. That happened to be, where's Larry? We did forecast that, and that was the right forecast, and it was particularly important because at the outset of the war, the numbers were everywhere. So putting some kind of a number and a confidence interval around it was very important for the discussion. I'll say we had two slight things that offset each other in terms of that 2%. But nonetheless, on the left-hand side, you see credit card usage went down to 70% when the war started, and pretty much after October, went back to over 100%. So you would have a hard time finding a place in a restaurant in Tel Aviv these days. Unemployment, you could see, is going down gradually. In October is very, very high. It's comprised in gray, the usual unemployment. In dotted gray, it's the sort of temporary people who are laid off, just like in COVID. The dark blue is people in military reserves, and the top dotted blue is actually there were missiles, so people just stayed at home and didn't go to work. And you see, once that missiles were subsided, this thing is going back to the regular level of unemployment. And if we don't have official April numbers, but this is continuing to go down. And then our forecasts are 2% and 5% going into 2025, which it puts us roughly back on trend at the end of 2024. What are the two things that have surprised us? On the one hand, how fast demand is coming back up. You could see that in the credit cards. On the other hand, there are supply shocks, like, for example, in the construction industry, which is about 6% of GDP, so it's important, whereby about a third of the workers are Palestinians from the West Bank. And at this point, they are not in the working force, and that's sort of puts a ceiling on some of the growth rates that you are seeing there in 24 and 25, plus the idea that under the rosiest assumptions of how this event unfolds, they will need more reserve days for many of the people, and that will detract a little bit from growth had we not done it otherwise. So I want to go to financial markets because that's where we acted as a central bank. Although we are officially the advisor to economic advisor to the government, so we're very active on the fiscal as well as these projections. So first of all, this is in blue. You see the actual exchange rate. In orange is is a very simplistic model based on NASDAQ what the exchange rate would be. First of all, if you ever wanted to see a structural break, you see it in the judicial reform. You could see how these things took apart, and we had excess depreciation of the currency. But then the war started, and you could see the currency went from 385, 386, all the way to 408, and then subsided to about to lower levels than even prior to the war, to 36, 37. So what did we do? First of all, Sunday, October 8th, is a working day in Israel. I have to decide whether things are open, the banks and everything. That was, on October 7th, we decided to do that we have a whole bunch of criteria, but it was a hard decision, and it was ex post the right decision. Monday, FX market open, and there's going to be action there, and we could see that already very early in the trading in Asia. And what we did is we preempted before markets open in Israel, and we announced that we are going to sell up to $30 billion. We're going to provide up to $15 billion of swap. And this, I'm looking at Daryl, and Daryl always talks a lot about liquidity, and so this was very, very important. And when I think of monetary policy, especially, I think of one lever as first, financial stability, and I don't mean here necessarily a bank. I'm talking about functionality of markets, and that takes priority lexicographically over normalization, inflation, and other things, and that's your first focus point, and that's what we did on October 9th. And as I showed you in the previous slide, it was enough strength to put there. Also, people knew that we have all these other reserves, that in spite of the events unfolding, there was no overshooting. This had good periphery effect on the stock market and the bond market. It was very, very important that these things had continued to function. If we know something in economics, you don't want an economic crisis to spill over into a financial crisis. And that was the first step. To alleviate an anxiety at the household level, what I did a couple of days after that, I got all the CEOs of the banks, and so there was discussion here about regulation, but that allowed us to put on a uniform agreement where they all defer mortgage payments, consumer loans, and loans to SME for 3 months, no interest, no commissions, at least for those who live around the Gaza border and those who are going into reserve. And I thought that was almost like a targeted interest reduction. At the same time, everybody in the country became Keynesian, and the media said the governor has to lower interest rate. And I said no, and we had to teach the people, no, right now the lever that is operating is first making sure financial markets function. We're not going to sell dollars, and on the other hand, lower interest rate. And so for the first two interest rate decision after the war had started, that's what we did. As I told you, the shekel went all the way down to 3.6 at around January. Things looked a little bit more calm, and we lowered the interest rate then from 475 to 450. But then afterwards, geopolitics kicked back in, and we signaled to the market, as long as they are there, we are going to maintain course at this level. In fact, our forward guidance is about first stability, then the inflation process, whereas John, we even mentioned, because there's a lot of fiscal issues, which I showed, depends what fiscal policy will be, et cetera, et cetera. So that's where we are right now. A few words about the cost of the war. The direct costs are about 13% of GDP. So fiscal is very, very important issue here, and it spills over into inflation. How does it spill over? In the sense that fiscal is about 13% of GDP, 2% is about lost revenue, 8% is sort of replenishing of the military, but clearly there's an attempt to put into the future more permanent increase into the military, and those are going to burden the path to debt to GDP, and against those, we insisted there would be some kind of fiscal adjustment. And some of them, because of the shortness in doing adjustment on cuts on expenditures, because civilian expenditures are already low, they had to be through VAT tax, through tax on healthcare, through other means. So those taxes, plus recent increase in energy, and the fact that there is a negative supply shock on the housing, all now changed also, or raised somewhat, the expectations and the realized inflation that we're seeing coming, which of course is putting more of a damper in terms of, in terms of the ability to do normalization farther, and we'll have to see how that continues. But the important part is that the government did do, after it took a lot of work to convince them to do fiscal adjustments. And so at least debt to GDP, there is sort of where on the gray line where it does not diverge. And I thought that was very, very important to message to the markets. So now I want to go and talk more generally about small open economies. There's generally a commonality in business inflation and interest rate cycles across large and small economies. Yet we're seeing countries timing it differently, and also the extent of monetary policy. The economies that sort of raised rates after the Fed seem to experience a faster decline in inflation. And basically higher Fed rates sort of help reduce inflation in small open economy, and that usually operates through I think Richard Claret yesterday said, you know, when the Fed acts, it kind of has this effect around the world. One way to see it is directly in the PMI, in commodity prices, and in imported inflation from the US. Yet many small open economies choose not to use the Fed's headwind. And so we'll try to think, what are the reasons for that? And obviously, FX comes into mind, differential exposure to energy, and I'm going to talk about the mortgage market. So let me go. So first of all, you could see here, basically the US is in red, inflation and interest rates, and this is a bunch of small open economies that are written at the bottom, and this is the average of them. And you could see the cycle is kind of similar, but the magnitudes and timing are not perfectly aligned. But if you zoom out, there is this commonality. Yet if you look at the recent cycle, how restrictive they were is kind of different. So what's on the x-axis is the number of months in which each central bank has been above its target. And on the y-axis, you have some, I would say, simple notion of restrictiveness, which is just the central bank rate minus inflation. So this is not the real rate, but it's some notion of that. So for example, when you look at the US there at -8, that's when the interest rate was 1 and inflation hit 9%. And obviously, this is not saying it's full restrictiveness. You would need to benchmark things relative to R star, but at least above 0, you would think we are beginning to be in somewhat restrictive area. And you could see the different depth and cycles the different countries have gone here through this period. So there's this commonality, but they reached if you take it to be at least positive as restrictive, it took a very different periods throughout time. So here I have basically a projection of inflation, and what you're seeing is that rising rates in the US itself dampen inflation in small open economies. So this is like an impulse response. You can control for the small open economies interest rate or not. That's the difference between the blue and the orange line, but it's pretty, it's pretty striking and probably not that surprising. What you see here on the graph is on the y-axis, you see each country's how much time it took them to basically decline the inflation by a half from its peak. Okay, so this is how fast they've dropped their inflation. And you could see here which countries moved after the Fed, and you could see that this is, I don't want to overemphasize it as like a super identification and control exercise, but it is very suggestive that those that move after the Fed sort of had a faster decline process than those that moved prior to that. So the question on the table is, what are the channels for the Fed headwind? And then the question, why not use it? So first of all, I talked a bit about the PMI, so I can go relatively fast here. You could see that when you do these local projections of basically the PMI on the monetary policy shock of the US, you get a significant effect, and then that translates into basically the inflation of the small open economy. You have some magnitudes there in the title. It's people like to mark it as 100 basis point Fed shock. There is never 100 basis point, or I shouldn't say never, but generally we don't think of 100 basis point Fed shock, but that's how it is scaled. The same is true for world commodities. This is, you could see the drop in inflation. It takes it a little bit longer. The drop in commodities, and then you see how that, on the right-hand side, how the drop in commodities translates into lower inflations in the small open economy. And the third component is imported inflation directly from the US, as it is a major trading partner for many countries. You could see that obviously the impact of the Fed shock on US inflation, and then on the right-hand side, how that shock corresponds to its effect on small open economy. So all these three components are very, very, very important. So the question is, what is going on? Why are all these countries moving earlier and not just gliding, so to speak, on the Fed headwind? And there's lots of reasons to do that, and that's why there's more than one central bank, probably. And I want to touch the FX, which probably is on everybody's tongue, actually at the end. So the first one is energy to exposure. There is huge, and we saw that in the Ukraine, Russia, that was very vivid. The countries that were very close in Europe, the effect of energy inflation, and actually even food inflation, which was also wheat and other things that were coming out of that region, was very, very important in terms of the exposure of different countries to that component of inflation. This is very large differences that create a very different implication. And we saw some of the countries that moved early. If you saw it, Hungary, Czech Republic, et cetera, these countries were exposed to that. John Cochran, here is for you, fiscal. So obviously, this is very, very important. And post-COVID, while most countries apply some kind of fiscal expansion, there are great differences in the amount. And I don't think that even fully reflect how that it's also important to know how that fiscal expansion was done. Is it a check to every citizen? How is it exactly being done in terms of how that affects inflation? But ultimately, you could see these are very big differences, and there's a long literature on how the fiscal ultimately affects these things, and it's true in advanced economy as well as emerging economy. The last thing I want to talk is about the transmission of monetary policy and the institutional differences across countries. And I think one of the biggest differences in markets is the mortgage market. And here what I have in mind is fixed rate mortgages. When you have a fixed rate mortgage market like the US, when you raise rates, you're affecting the newcomers into the market primarily. When you have almost 100% variable rate, in Norway, for example, it's 95%. In Israel, the typical mortgage is 1/3 fixed, 1/3 ARM in real terms, and 1/3 tied to the central bank. As usual, we have to complicate things, so that's the typical mortgage. But nonetheless, when you go on a TV show after you raise rates, before you get on the show, there's a family who's talking about their monthly payment that just went up. So the bottom line is the potency of a monetary policy and the speed and potency is very, very different. And this is a very large market. We know that households' wealth, a lot of it is tied down in the housing market, and therefore it makes a big difference. And you could see over on the left-hand side, there's big differences in the structure of mortgage markets across countries. And on the right-hand side, you could see the effect of the local interest rate, the differences across high and low fixed rate markets. So now let's talk about the exchange rate. The exchange rate differential, obviously, when the US raised rates, holding everything else fixed, the dollar gets stronger and the other currencies depreciates. This figure looks at the DXY, so it's a combination of currencies, so it's significant. We know it's there. So now I want to make the point that when central banks and some of these central banks come about to make their move or not move relative to others, it's really important happens to be their initial point vis-a-vis the exchange rate, holding, of course, all these other considerations. So what you're seeing here, and if you have a memory of that figure that I told you who moved first, you will see that Chile, Hungary, Colombia, Iceland, and South Korea, those are some of the countries that moved first. Those are countries whose currency actually have depreciated quite a bit through the COVID, the 2019 to 2021. So they didn't have a big problem raising rates from a perspective that an appreciative currency would do. On the other hand, you look at Israel, Switzerland, or Sweden, some of the other countries there, we had a currency that actually had appreciated in the period that's coming into the period in which inflation was rising, and therefore raising rates even farther obviously would appreciate your currency even more, or in other words, you can actually afford to wait and use the Fed's headwind. And in fact, this is more formalized in this regression that again look, and I don't want to appeal too much to causality here with all the identification, formal identification, econometric people. This is still at work, but this is, again, the real exchange rate here, and you could see that higher level indicates an appreciation of the economy currency against broad basket of currency, and you could see that on the y-axis, it's the date of first interest rate hike in relation to the U.S. So you are seeing this kind of what I just described verbally. And then, given that John Taylor is here, I cannot escape not talking about the Taylor rule in the context of a small open economy. So, if I was paraphrase what you wrote in the AER paper and proceeding about the Taylor rule in small open economy, I think the ultimate conclusion is kind of don't complicate things. At the end of the day, it doesn't help too much from the simulation. And yet, many small open economy do respond to changes in exchange rate. Moreover, as Lupik and Shorefide show, central banks account exchange rate in their Taylor rule, or at least many of them. In Israel, we do. We have a very small coefficient. So the question is, why is that? And of course, there was a discussion of the role of Taylor rule. I mean, it's certainly a tool that at least before you get to judgment calls, is something you use in the background. So one is timing and information. We all know that both the inflation and certainly output gap is hard to measure. It comes in with a huge lag, whereas here is a financial variable that's, is a little bit more timely and provides a lot of information. And then the exchange rate, and when I talked about the exchange rate a lot, and there's a lot, obviously in the background for some countries that are on the extreme end, capital flight out is obviously a consideration. There's the issue of financial stability that is related to that, and so that's a reason to put it there. And but I think it's John, we are ourselves sort of playing around with it, whether your conclusions are in that original paper are really reduces, let's say, the root mean squared error of the central bank. But at least these are the reasons that conceptually you would think an exchange rate would be valuable in the Taylor rule because it provides that extra information, timing, and the financial stability. So I think I'm out of time, and thank you.
Okay, thank you so much for the invitation to this conference. It's a special treat for me to see John Cochran here, my old neighbor from across the street. John and Beth used to keep our emergency house key for us. The alarm company would call them if we were out of town and something went wrong. So I'm hoping that if things go sideways in my talk today, you're still willing to be the emergency contact, just to reach him. And I should also add now, to the great relief of John Williams and my other colleagues here, that these views are my own. They do not represent the Federal Reserve System or other members of the Federal Open Market Committee. Today, rather than talk about the economy at a high level, I wanted to narrow the discussion to talk a bit about central bank communications. It's a topic that received a lot of attention even on the previous panel, but it's gotten increased public scrutiny and attention recently. And I came to thinking about this in sort of an odd way. When I moved at the beginning of last year from the University of Chicago to the Chicago Fed, it felt like we had just lived through a really crazy moment in economic history. We had started a rather historically rapid tightening cycle, and there were a large number of fundamental economic issues that needed discussion and resolution. I then went to my first appearances where the press was there, ready to talk about that, and the questions centered always on the same thing. How many rate hikes do you have for the coming year? Now, I was a little disappointed and a bit dismayed, actually, because by itself, with no economic context or rationale or even understanding of what a person thinks will be happening with economic conditions, the answer to the question, how many, is basically just speculation. There's very little economic content in a question like that. Why would they not ask about things that are actually informative about future decision making, like what's your reaction function? What is your economic worldview? What are your risk assessments? And as I puzzled on this and tried to think through why they did not seem as interested, they seemed more interested in context-free numbers than in economic description, I somewhat concluded that a bit of this is our own fault, because some aspects of our current communications, especially in the SEP, actually encourage exactly this kind of speculation. So today I'm basically would like to make 3 points. One, where I think the Fed communications, and particularly the summary of economic projections, fails to deliver on the kind of economic information that it could deliver on. 2, how we might improve that. And then 3, the important role that I think participants, FOMC participants, public speaking and writings can be for communicating their reaction functions, and the conveying of risk management considerations can be for the committee. And I guess I will conclude with a bit of a defense of the cacophony problem, which is a much maligned bugaboo, but I will say there are some aspects of it that I think are positive. Okay, so point 1, what is the problem as I see it with the SEP? And given the previous panel, I have a little section about why should we care about this, but it's probably obvious why we should care. Everybody knows that the communications issues of central banks, they have been important and with us from the beginning. They're closely tied to inflation expectations, to bank credibility, and even to public trust. I don't know that I'm fully on board with Ben Bernanke's comment that monetary policy is 98% talking and 2% action, but we all understand the importance of people having a clear understanding of central banks' goals and strategies in the monetary policy transmission. The Fed and many other central banks' approach to communications has changed dramatically over the last 30 years, and it has shifted to much greater transparency. And one of the leading components of that has been the SEP, and especially the dot plot of FOMC participants' interest rate projections. And in that dot plot, each person on the committee gives an anonymous answer to the how many question, and does so for the next several years. It is widely followed. It provides a dose of transparency about the diverse collection of views, and the influence seems to be spreading, is the subject of discussion from the Bernanke report in England, and recently there have been high-level consideration of whether the ECB should adopt a dot plot. As a starting point, it is worth noting that in the 2020 Hutchins Center survey of academic and private sector Fed watchers, only about 50% of respondents reported that they even find the dot plot useful. Now, I think one of the things that may be pulling that number down is that the SEP is not actually that useful for identifying FOMC participants' monetary policy reaction functions. And by that, I'm defining the reaction function broadly, how a person would react to changes in economic conditions, rather than in a technical way like what is that person's, what are their policy function coefficients in a Taylor rule or something like that. I find myself mostly in agreement with the old Mervyn King argument that it's a sign of success for the central bank when markets react to the new data releases more than to the statements of central banker opinions. And one of the key ways to achieve that kind of outcome is that people need to understand what are the FOMC participants' reaction functions. The reason the SEP isn't that helpful in communicating them is partly that each participant's rate path projection is tied to a forecast of economic conditions. But as you know, the SEP does not report which conditions go with which rate prediction. And the widely reported median does not give you a coherent observation, because the person making the median rate projection is not likely to be the same person that made the median inflation or GDP projection. So without the connection of the economic conditions to the rate projections, the dot plot is just a collection of opinions with lacking economic content. So it's no wonder that the press doesn't ask about anything else, because our own major communication document implicitly says that an economic rationale isn't needed. It says, just tell us how many, and we'll put them on this dot plot and hand it out. And because it can't be connected to those economic conditions of what the participant thinks will justify that rate, there's no way to explain why they're saying what they're doing. So point two, how would we improve it? I think we can make it better in a way that folks have already talked about. But I think that it's worth looking, that this is actually the cousin to the old debate about time-dependent versus state-dependent forward guidance. And I know that there's controversy about forward guidance, and some people hate it and some people like it, but this is like the old Trident gum thing, that 4 out of 5 dentists recommend sugarless gum for their patients who chew gum. Regardless of whether you like or dislike forward guidance, I think we can agree that state-dependent guidance is more useful than time-dependent guidance, because it conveys economic content and an implicit reaction function. So in 2011, the committee saying it doesn't expect to raise rates for 2 years is not nearly as helpful as an Evans rule that says the committee will not consider moving until the unemployment rate is below 6.5%, as long as inflation is below 2.5%. The time-based guidance is basically just an opinion. The Evans rule clarifies what the committee is watching, and it conveys information about the reaction function. So now think about that for the dot plot. The dot plot is a lot like time-dependent guidance. It's not tied to anything, and we would be better off if it could be more like state-dependent guidance, conveying a reaction function. So how could it be done? How could we do this? First, I'm going to echo some of the suggestions that are in Mickey and Charlie's paper that we just heard about. I think it would go a long way to simply publish the matrix. That is, it doesn't need to be personally attributed to each person, but at least on the dot plot, put what the anonymously match the economic forecast to that dot, so that you could answer some clarifying questions. For example, you observe a high rate dot for the next year's funds rate. You could tell, if we published the matrix, whether that was a person who thinks the economy is overheating and they want to rein in inflation, or they think that faster non-inflationary growth implies a higher equilibrium rate. Today, you can't tell the difference between those. Over time, as we saw observed changes in the economic environment and the impact that it had on the projected rates, that would reveal even more about what the reaction functions are. And other more direct forms of state contingent information might be to add something like the way we do the stress tests for banks, or the alt-sims in the Teal book, asking of the form, what would you think would be appropriate action if X happened? Now, it wouldn't be easy to implement that, as easy to implement that as publishing the matrix, but it's food for thought of how we can convey reaction functions through more state-dependent type guidance. Lastly, I'd like to say something about commentary. Since you know my goal is let us convey information about how participants might respond to economic developments rather than just speculative opinion, I find it also helpful when their speeches and writings explain their thinking and go beyond simply making predictions. And this idea highlights an important piece of communication, which is conveying the implications of unusual circumstances and risk management for setting policy. Especially in times of heightened uncertainty and unusual risk, the policy playbook gets complicated and it requires more than just dots. And such times, as Larry said, seem to be happening with uncomfortably high frequency these days. The committee has historically communicated unusual circumstances and practiced this kind of risk management policy for a long time. It shows up in formal, voted on FOMC statements, policy tilts, other communications over the last 30 years, like the Asian financial crisis, the Russian default, the threat of deflation, the great financial crisis, the Great Recession, and the pandemic. In all of these cases, I view that those communications were an important tool to get us beyond a kind of a context-free how many discussion, and they provided the public with better state contingent information. In the pandemic, as you know, we even paused the SEP because we said times are too wacky. It doesn't make sense to do that. So I guess I conclude with a plea that we try to push the communications and especially the SEP to better convey how we respond to economic conditions. I think it does mean a larger number of voices saying a larger number of things. And so Alan Blinder in an old paper and others have called this the cacophony problem. And they will probably view as a negative to have this much information getting conveyed this frequently to the public before every meeting. But I don't agree with the complaints about there being too many voices. Yes, of course, it would be easier to understand if there was just one voice talking about policy and they gave just one opinion. But fundamentally, the FOMC is a committee with lots of views, and the policy made gets forged in that environment of discussion. Without intentionally trying to offend the US Senate, in my view, in the 21st century, the FOMC has become the world's greatest deliberative body. And I think having folks on that committee with different worldviews makes for better decision-making, not worse. And there's nothing wrong with the public knowing these views because that's reality. It's not just decided that there isn't just one dot and there isn't just one worldview. So today, I feel like we're conducting policy during a fascinating and uncertain time. How we communicate will be critical. If we put out an SEP-style communication of information, we should endeavor to convey our deliberations and our thinking, not just our opinions. That's why I say that how many is not enough.
Right. Well, good afternoon, everybody. It's wonderful to be here back at Stanford, especially here with John Taylor chairing this panel. For those who don't know, John was my advisor during my studies here, and he hired me as a research assistant in the early 90s. It was an extraordinary privilege to have those two most wanted positions. Now, based on some of my past speeches, you may expect me to give a few pop culture references from the early 90s that capture my time at Stanford, but the honest truth is I was too focused on my studies here, and there wasn't time to rollerblade, listen to REM, or go to the arcade just for fun. Instead, like most of us in this room, I chose to forsake fun for the study of economics. As a result, if people want to play Trivial Pursuit with me and the question comes up about 90s trivia, I am simply useless at that. But in a serious note, what brought me to Stanford back then was a sense of purpose. Growing up in the 70s and the 80s, I witnessed the toll that economic turmoil, high inflation, and slow growth took on families. By the time I arrived in Stanford in the fall of '89, the Federal Reserve under Paul Volcker had tamed the very high inflation of the late 60s and 70s, but the work was far from done. Inflation was then around 4%, a level I should note that is well above today's 2.7%, and it was not yet clear how the lessons of the past would shape the policies of the future to ensure economic prosperity and stability. But change was afoot, and it was an exciting time to be thinking about economic policy, especially monetary policy back then. With the advent of inflation targeting, the practice of monetary policy was on the cusp of a revolution. The Reserve Bank of New Zealand led the way in December of '89, just a few months after I got here, and the Bank of Canada and the Bank of England soon followed suit. And I recall seeing the excitement around this change when I was a student, and John very kindly invited me to meet with and listen to policymakers from New Zealand and later Canada as they described their new frameworks. At the same time, economists were reassessing what good policy looks like and how it can make a difference. Of course, John Taylor and many others were re-examining the theory and evidence behind the ways policymakers could consistently deliver low and stable inflation in the post-Bretton Woods era. And I should note this post-Bretton Woods era because a lot of the debates in the 80s were really to think about what should the instrument of monetary policy be, whether it's monetary aggregates, the exchange rate, or using the interest rate. Now, my introduction to this topic, in fact, my introduction to, I think, modern monetary economics was when John asked me to run model simulations for his forthcoming book, Macroeconomic Policy in a World Economy. And that built on years of research by many experts using different models and frameworks to think about these questions. The book provided a rigorous analysis of alternative monetary policy regimes, I think importantly, in an open economy context. And we were talking about yesterday that theme of this conference, I think, really is about global monetary policy. And that's something I got introduced in very early on. Now, of course, this whole line of research culminated in John's seminal paper, Discretion versus Policy Rules in Practice, which brilliantly synthesized theory and experience to yield clear prescriptions for good policy. What I learned then and have carried with me these past 35 years is the importance of connecting theory and experience. The theories that shape good policy are derived from the experiences of the past and therefore create lessons for the future. That prepared me well for my career, and it's what I'm going to talk about in my comments today. Of course, before I go any further, I'll give the standard disclaimer that views expressed are my own alone and do not necessarily reflect those of the Federal Open Market Committee or anybody else in the Federal Reserve System. But between the time I left Stanford and the onset of the pandemic in 2020, the theory and practice of monetary policy changed dramatically. Policymakers sought to avoid the mistakes of the past and worked hard to create new frameworks for the future. And economists developed and refined the theories to guide policy. The result was a prolonged period of price stability that spanned a quarter of a century. We learned three key lessons from theory and experience. The first is the central banks must own the responsibility for price stability and have the ability to act as needed to achieve it. Policymakers have the tools to attain and maintain low and stable inflation. However, too often in the past, and I think back most notably to the 1970s, central banks behaved as if they were powerless to control inflation. Although accountability for price stability is critically important, history also teaches us that central banks that have independence in their actions are more successful at delivering price stability and well-anchored inflation expectations. In short, our job is to be the protector of price stability. Now, the second lesson is the importance of transparency, and in particular, the clear communication of a goal for price stability in the form of an explicit numerical inflation target. Agreeing on a longer-run target reinforces the public accountability for price stability and focuses the internal policy debate on how to best achieve that goal. And I think this is often missed in the academic discussions about having an inflation target, because one thing that having been at the Fed a long time, is we don't debate anymore, are we aiming for 0% inflation, 1%, 2%, 3%, or 4%? We all come into the room having agreed the 2% longer run inflation goal is what we're achieving. And the question is, how do we best achieve that along with our maximum employment? Central banks that adopted inflation targeting led the way on this, and the FOMC, of course, we announced our 2% longer run inflation goal in January 2012 as part of our statement on longer run goals and monetary policy strategy. So that leads to the third lesson, the importance of well-anchored inflation expectations, and we saw some charts showing that this morning. By communicating an explicit inflation target and then delivering inflation consistent with that target, central banks earn credibility with the public. That helps anchor expectations, which in turn contributes to low and stable inflation. This feedback loop between policy actions and communications, expectations, and price stability is now a core tenet of modern central banking. But honestly, it wasn't something that was fully appreciated or widely accepted just 30 years ago. Now, it's important to note that anchoring inflation expectations at the target level is symmetric. Very low inflation or worse deflation can be as problematic as high inflation, presenting challenges for policymakers and harming the economy. Now, as a result of the linkages between theory and experience, our three lessons became three principles, and they helped us achieve a quarter century of low and stable inflation and well-anchored expectations, and I would say across the globe in most countries. Then came the pandemic, which dealt the most dramatic shocks to the economy in generations. Severe imbalances between supply and demand, exacerbated by Russia's war in Ukraine, caused inflation to skyrocket in most countries across the globe. In 2022, inflation peaked at 7% in the United States, rose to 8% in Canada, and exceeded 10% in the euro area. And again, as we discussed, and I thought that was a very good panel, we discussed the emerging market countries, which also experienced very high inflation during that period. So how did we, along with all the central banks, address these spikes in inflation? Well, speaking about the United States, we stuck to our three key principles. First, the FOMC clearly owned the responsibility for reining in inflation. Achieving price stability and maximum employment are our dual mandate goals, and we took strong, decisive actions to bring inflation down. Second, we've been unequivocal and transparent in our commitment to achieving our 2% target on a sustained basis. This message has been emphasized over and over in the FOMC's post-meeting statements and policymaker communications. And Austin, I think one thing we can say safely is that all 19 of us have repeated that consistently over the last few years. Third, we've paid close attention to inflation expectations. And our actions and credibility built up over the preceding quarter century helped keep inflation expectations anchored. We had very good initial conditions coming into this. Although medium and especially shorter term inflation expectations rose notably starting in 2021, they retraced those gains over the next few years. Indeed, using the New York Fed's survey of consumer expectations, 3-year ahead inflation expectations returned to pre-pandemic levels by late 2022, which is really quite remarkable given the inflation peaked in the middle of 2022. And short-term inflation expectations returned to pre-pandemic levels late last year. So what do the lessons of the past mean for the future of monetary policy? I believe they prove once again the importance of theory and experience. Years of experience and years of careful analysis have taught us that first and foremost, we must own the responsibility for maintaining low and stable inflation. We have the independence of action to achieve that goal. Price stability is absolutely essential for economic prosperity, and it's crucial for achieving and sustaining maximum employment over the longer run. Theory and experience have also shown the importance of transparency and clear communication, including setting an explicit longer run inflation target and of taking appropriate actions to support the achievement of that goal. These are critical in anchoring inflation expectations, which in turn help keep inflation at the target. So the future is highly uncertain. I think that was a theme of today. But as we continue to move closer to our 2% longer run goal, I'm confident that we have the foundation of theory and experience to guide us in restoring price stability and set the stage for sustained economic prosperity. And we're committed to getting that job done. Thank you.
Okay, we have a lot of time for some good questions if anyone wants to raise their hand. If not, I guess there's Andy and then John.
Well, first of all, thanks to John and Mike, really amazing conference today. We're not even done yet. We get to have Ed at dinner today. But I just have a comment and question for President Goolsbee. So Don Cohn, one of his favorite sayings that he repeated many times when I was a staffer at the board was, communication is a work in progress. It's never done. It's a work in progress. And so when the dot plot was created, in 2011, everyone, and I think Charlie Pollicy can attest to this, everyone expected that it was just a step, on a trajectory toward further improvements in communication. If you imagine at that time, the FOMC had for decades been producing economic projections under the assumption of appropriate policy without telling anyone what those assumptions were. And so the dot plot was simply an effort to try to say, okay, let's now let people know what committee participants' assessments of appropriate policy are. But the ideas that you mentioned about publishing a matrix, I would say think about names, alternative scenarios that you mentioned, and others. Let each person write down their own policy benchmark, which could be a Taylor rule or a Fidesz rule or a nominal GP rule or whatever it is. My question for you is that the last framework renewal was really focused just on the statement on longer run goals and strategy. And so I'm wondering, as you and your colleagues are looking ahead, creating momentum, that maybe the SEP is the low-hanging fruit here, and lots of ideas that you can get about how to make progress on it.
Thank you for that. It is a couple of, there's some interesting ideas, and there's a kind of a couple of questions in that. I wasn't thinking of this as strategy review, and I was thinking it more narrowly about communication. It's worth each of the things you're describing, like that participants would write down what rules they're following, what data they're watching. That's in the spirit of exactly what I think would be useful. I could see, as compared to nothing, the SEP conveys a lot more information. I will say I have unease with making projections so far out, 1, 2, 3 years, that people might come back if you're putting names, and then they'll say, oh, you're the dummy who thought, this was going to be in 2026. But all of those, I think, are worth thinking about, because I do think there is a little bit of element of low-hanging fruit. We're so close to being able to convey information that would really be about individual members' reaction functions, and the public could get a sense of, if X happened, here's how they might react.
John Cochran.
I'll address this to Sean Williams, but it's a larger question which anyone might take, because we've been talking about it all day. Just because John said 2% numerical target is great because it gives accountability. And that was the idea behind the inflation targets, accountability. Yet the target was 2, we hit 8. Cumulatively, it's been like 15 or 20 over what it was supposed to be. You can correct me on the cumulative number. More than 8, because 8 was the 1 year. But a major miss. And I don't see any sign of accountability. Internally, I don't see, at least a public, what the hell went wrong? What are we going to do about it? The standard sort of inquest about something major went wrong. Externally, I don't see any accountability. It's kind of interesting that the administration, who is, as Larry pointed out, is about to lose an election over this, didn't blame the Fed. Instead, they're blaming the potato chip makers for, putting too few potato chips in a can, and greed, and the dog ate my homework, and everything else. But
Never change, John. Never change.
You would expect that they would be mad as hell at the Fed and saying accountability. and this is around the world too, I don't mean to make domestic jokes. Other central banks are not having at least any sort of public inquest about what went wrong, nor is there public accountability. So the whole accountability thing sounded great, but it doesn't seem to be happening.
Yeah, well, first of all, other countries have been doing various, either legislative mandated kind of reviews and things like that. So that's actually, it's happening in some places. And of course, the Bank of England just had the Bernanke report themselves. I think accountability, obviously the chair is, testifies to Congress regularly and explains the decisions we make and where we've missed on our goal. I think the accountability is really about, we got hit by enormous shocks. We've made our own decisions, which obviously added monetary stimulus during 2020 into 2021, and then the point of the accountability is, we're absolutely clear that 7%, PC inflation peaked at 7.1%. That's our targets based on PC inflation. That this is totally unacceptable, and we have to use the strongest measures we have to get the inflation back to 2% and act every single day towards that goal. So there's no question that we missed our target by something like 5% each points in 1 year, and then we acted, I think, decisively, and so far have been helping. A lot of factors are bringing inflation down, but I think restrictive monetary policy is one of the reasons we've gone from 7% inflation to 5 to 3, and now at 2.7, and ultimately get back to 2. I think the important thing on the accountability here is also that to make sure that inflation expectations are well anchored, so that when you look at households, I'm talking about households, not just financial markets, or you look at, and not just look at economists, they are expecting now, because of the Fed's actions, and I think in our communications, they expect inflation will be over the next 1, 3, 5 years, similar to the inflation they saw before the pandemic. I think that is a remarkable statement about, I think, the relationship between accountability, obviously the actions, after extraordinary period of the pandemic and the war, which again, I agree with Yuri's comments, it's not just the pandemic, there was a lot of huge shocks, to bring inflation down decisively, as quickly as we can, and get it on a sustained base back to 2%. So I think that that's the part of, I think, accountability too, not just going back and saying who's holding us accountable. I do think that one of the things that we're not doing the framework review now, but to me, just speaking for myself, I think to fully understand what the lessons of the past 4 years are, we need to see how this plays out. If you asked me or you, John, because we've talked over the years, 2 years ago, what were the lessons of the pandemic and monetary policy? We would have come up with some tentative answers. If you asked a year ago, if you asked in December of last year, you might have come up with a very different answer. If you asked today, I think you come with a different answer. What that teaches me is we need to let this really learn what happened, how did monetary policy, fiscal policy, supply and demand shocks, shutting down economies, reopening them around the world, how did that affect inflation or economies, and what are the real lessons from that? I think, I've learned not to say what inning of the game we're in or what quarter we're in, but we still don't know the answer to these questions. I know that one of the themes is to show humility, but this is the one thing that we have to be humble about. We really don't know all the lessons from this, and I think it's important for all of us to take some time and get all the evidence, not just from the United States, but from the other advanced economies, and having worked closely and through my role in the BIS with the central banks around the world, learning from their experiences too, because some of them moved aggressively early, as Amir, you talked about, some waited longer. Let's get all of that evidence before we really come to firm conclusions.
In a way, if I could add one last thing.
Sure.
The thing about a 2% target is that I feel like it implicitly says whose job is to hold accountable. And it's that the market and the expectations are the judge of accountability. The frustration in your voice is kind of like, well, I saw that the inflation rate was way higher than 2%, so I want them to be punished. But it lays out the market is the one to decide that. And the market decided that the Fed did not do a bad job. That even as, if you think of Emmy's graph, in the earlier periods when headline inflation goes up, expectations went up. The fact that the market did not expect that the inflation would last says, I think you got to cut a little slack to. I wasn't on the committee at that time, but I think you got to cut them a little slack.
Amir, you want to comment? Yeah.
I'm not going to get into the Fed accountability issue here. I just want to actually follow what I think John is trying to say. I think this was a period with huge shocks, and one of the issues, now I'm talking maybe the more academic hat, we got to figure out, these seems to arrive more frequently perhaps than we used to. We got to put a way to put these things into our models in a more salient way than just our usual, the way we usually treat them, and that could be one important tool to at least deal with these things as we go forward.
Hi, Chris Crow from Capula. I think that a lot of the arguments for central bank transparency are sort of unanswerable, but one paper that always gave me pause in this debate was the sort of Morris and Shin work arguing that central bank communications become a kind of focal point for the market and leads to market participants putting too much weight on what the central bank says. And, you know, now working in financial markets and kind of talking to colleagues who trade and listen to central banks speaking, I think, you know, that kind of paper seems quite relevant to me in my current role. It's sort of reminiscent of our joke about you know, complaining about the quality of the food, but also saying that the portions are so small. You know, it's sort of an element of that when traders listen to central bankers. So I was wondering is there something that central banks can do to sort of get the markets to maybe listen to them a little bit less?
I was going to say, the Morris and Shin paper, there are a few papers. They're fun papers. I think they're quite important. The idea, in a way, is the market stops finding out information for itself and it grows addicted and dependent on the central bank to give it the information. The only thing that I'll observe is if you plot what the committee has been saying and then you plot what the market implies, it's the opposite dynamic. We've been very steady, and the market is like, if our SEP says, okay, we anticipate 3 rate cuts for the year, that must mean 7. This, and then they have a press. Well, it must be down to 1. You know, and so that in spirit is kind of the opposite of the implication of that theory. I guess I would say.
Yeah, I'll get very geeky, nerdy on this. I mean, Lars Svensson had this brilliant, I think, kind of counter argument, which was published in the AR as well. And you know, the Morris and Shin, and if you can get in that model, that one particular model, if you can get your better and better communication, that result is turned around. The more communication is better. But I think that, you know, when I look at, I forget who said this earlier, but, you know, of course we all want for the world to understand our reaction function, for the, you know, when whatever data comes out, the markets respond to that. And that's kind of the way a good central bank monetary policy would work. And actually that is the way it happens most of the time. You get a, you know, strong employment report, you get a high CPI, the market adjusts to that. So I think that's what happens most of the time. Again, going back to this theme and, you know, of the past few years, can you expect that to happen during, you know, after in a pandemic or afterwards with all the other things that are going around? Well, no, I think these are uncharted waters. And so, you know, I think that the kind of forward guidance and more communication is helpful. But again, the hope is in normal times, whatever that reaction function is kind of embedded in how markets respond. And I think that is true.
Okay. Order, Mike. My question is really for Amir Yaron. And when you were telling us yesterday and today what you did in early October 2023 to prevent a financial crisis and stabilize the Israeli economy after the Hamas attack, I was remembering what Roger Ferguson told us, what he did at the Fed after 9/11 when Alan Greenspan was trapped in Europe. And so my question is, how much preparation did you do? How did you do it? Was your experience sort of conditioned by the fact that you're always in a war? And, did you use scenario analysis? Did you do war games? It'd be really nice to know about how you guys prepared.
Look, we have a large toolbox, and like many central banks and us in particular, we always like to make sure we know what our toolbox is, expand it. Definitely COVID also got us experience on the other side, but we never sold reserves, for example. And there's a lot of operational issues that before this event. So yeah, we have a lot of tools, but you can only, and so you want to have these tools around. You want to think about them. You do a lot of preparations, but then when the time comes, you do have to make the judgment call of which one of these is the appropriate one and how much of it is to use. So as I mentioned, we announced we're going to use up to 30 billion, but in fact we used only 8. Okay, so as I mentioned, the market thought we tend to. There's a lot about transparency here. Sometimes I don't like it, but we tend to announce what our reserves are. That goes back to Stanley. Every end of the beginning of every month, the market was waiting to see how much did we actually utilize it, and the market thought we were intervening even more or selling more than we actually had to. And how you do all of that is also an issue. And but the bottom line, we've used 8 once the market saw. We only used 8. Some of the issues in the north border got settled, and that, as I showed you, the exchange rate actually went down to a level that was even lower. It appreciated more than the starting point, and that had a periphery effect on a lot of things. So to answer your question, it's a combination of preparation, it's a combination of prior experience, and then when it comes, you can't be on autopilot.
Jim Bullard. So there's been a lot of talk about the SEP, possible reforms to the SEP. So one way to look at the SEP is just that it's a sort of immature form of communication with the public that's interested in monetary policy. Why not just produce a quarterly monetary policy report like other central banks do? Shouldn't that be the international standard? If you produce a report, it can be many pages long. You can address peripheral issues and give a more fulsome discussion of the state of the economy, state of monetary policy. And then individual members can then go out and refer to the monetary policy report and say how their views differ from what is presented in the report. So it seems like this might be a better way to go than to take the flawed and sort of fragmentary information that's given in the dot plot and start to color the dots different colors and put stripes in there and stuff like that.
Maybe, I guess I'd say. You were there and John was around when they were coming up with the dot plot. And I know that if you go back and look at the transcripts, there was discussion and debate, can we have a consensus forecast? and they decided no, and I kind of can see why they would not be able to come up with a consensus forecast. It depends what would be in your monetary policy report. If the monetary policy report would have to get a quite diverse committee to agree on a thing, I feel like we might spend a lot of time writing that report, and that could be spent doing otherwise, but in spirit, that sounds right. You know, people can explain how they think. That goes in my space of what to do.
Yeah, I think, can I just a quick comment? Yeah, because I was there a part of that, and there was an effort to try to figure out how to do that. We have 19 participants at the FOMC. One of the things we all believe is that's a strength. It's a range of views, range of backgrounds, different perspectives, and trying to find a way that conveys a kind of a center of the committee, at the same time the diverse views of that change over time is challenging. I think when you go to the consensus forecast and model, you're basically assigning the problem to everybody. Let's all agree to something, rather than assigning the problem of tell me what you really think. So I think it's a trade-off. I mean, I would love it if we could do all these things, but I think this is optimization under constraints. That's what economics is, and that's what policy making is. But I would also emphasize something that's important. The SEP is not a decision of the committee. And it represents the 19 views. You ask questions like, what do I think you said? What's GDP could be in 2026? The committee is focused on the monetary policy decisions and how to communicate them. And that's a different thing than just coming into the room, talking to your economists and saying, here's where I think, inflation and unemployment and GDP and interest rates are most likely going to be. And I think, if anything, that there is probably too much attention on the SEP as a committee thing rather than the FOMC statement and obviously the chair's, press conference and our communication.
Amy.
Just I'll say the international standard word that it's just infeasible for many central banks, just because there'll be 3 people. I mean, you would the minute well, obviously for the big central banks where there's enough large board that's feasible.
Emi Nakamura. One of the challenges with banking regulation is that if you do a really great job in banking regulation and there are never any bank runs, then there's always this cost of the bank regulation. Yes. And people can see it very clearly. And you try to tell them, well, if we hadn't done this bank regulation, there would have been terrible bank runs. Now, to draw the analogy here, when you look back in time and you ask yourself, with the benefit of hindsight, what would we have done? Suppose that you had, suppose in your mind, you would have hit the 2% target. So that may have involved, much larger interest rate increases, and certainly would have had an impact on stock market. Certainly, if there'd been any change in employment growth, there would have been a question as to whether that was a consequence of the Fed's interest rate increases. And then I guess you may have said, well, had we not done it, inflation would have gone up to 8%. But it might have been a tough sell. Anyway, I'm curious to know how you think about that with the benefit of hindsight. How you think about that trade-off?
Well, John just said we're out of time, Emmy, so I don't know if we can do this.
You got 1 minute.
Darn, it didn't work.
Gun.
I get it. I understand your question. I'm going to give you an unsatisfactory answer. As a policymaker, that's not the problem that we do, right? It's the problem is what you knew at the time. What were the trade-offs you thought you were facing? Ex post, going back, clearly the risks of economic weakness in 2021 were much less than they actually were, because the economy responded much differently. So I think that the way I tend to think about 2020 and 2021, especially like I said, the first half of 2021, is the uncertainty was just enormous. And you're basically doing, I'm a student of Tom Sargent as well, is you're trying to defend against the really bad outcomes. That's what we were doing in March of 2020. What's the really bad outcome is if the Treasury market stops functioning. That's what's a really bad outcome. So I think the trade-offs were really about the tail risks. The tail risk clearly, having lived through all of this, went from a severe economic downturn that lasted for a long time to very high inflation. And so we had to go from risk management on one side to guard against one set of risks to very strongly, decisively to the other. It's not really the Phillips curve or the sacrifice ratio, but more of a kind of, I'd say, managing those risks. And I was obviously very strong supporter of switching monetary policy in the direction and moving very strongly, given where the risks of an anchoring inflation expectations.
So we have to have last question, John Gunn.
Hi, John Gunn from retired Dodge and Cox Investment. Anyway, they're always great sessions, but I just have one quick question. The Bureau of Labor produces an inflation number that's never restated.
That's never reached what? It's never restated.
It's never restated because it's keyed to Social Security and all kinds of stuff. And so that number comes into your offices and you react and figure out what you're going to do. Do you ever investigate how that number is arrived at?
Yes, in the sense that we look at a lot of measures. That's the most important. It's the gold standard worldwide of price measurement.
So you look at other inflation measures?
Absolutely.
Oh, okay.
We look at price, all different kinds of price measures. And there's been an explosion with a guy, Pete Kleinow, who's here at Stanford. He and I got this online data with quantities, and Adobe compiles an online inflation price index.
Okay.
Sometimes it can look very different from the CPI. The New York Fed puts out a lot of data on various price measures, and we look at all of it.
Great.
Thank you so much. This is great.